April 2022. A 26-year-old named Marcus, graphic designer, a few freelance clients on the side, opens his mailbox and finds a letter from the IRS. Not a refund notice, not a confirmation, a bill. He owed $3,400 on top of what he'd already filed. Penalties, interest, amounts he didn't recognize tied to income he thought he'd accounted for. He sat with that letter for 20 minutes before he called anyone. His hands were shaking. Not because $3,400 was necessarily catastrophic, it wasn't, but because he had no idea where it came from. He'd filed what he thought was a clean return. He'd been careful. He hadn't been careful. He'd been uninformed. And those two things feel identical, right up until the moment the letter arrives. Here's what Marcus got wrong, and why most people watching this are probably making at least one of the same mistakes right now without knowing it. There are 5 of them, and by the end of this video, you won't be making any of them. Before the mistakes, you need to understand one thing about how the tax system is actually structured, because it explains why these errors happen so consistently across so many otherwise smart people. The system was not designed for clarity. It was designed over a century of legislative additions, amendments, exemptions, and special carve-outs built for specific industries, specific income levels, and specific political moments. What you're left with is a code base, and that's genuinely the right word for it, that runs 7,000 pages long and changes meaningfully every few years. The official guidance from the IRS is available to the public, all of it, free. And for most people, completely incomprehensible without a translator. So what happens? Most people do one of 2 things. They hand their return to a professional and trust that it's handled correctly, or they use tax software, answer the questions, and assume the software catches everything it's supposed to catch. And here's where it gets interesting, because both of those approaches have a specific failure point that almost nobody warns you about. And understanding that failure point is what separates a clean return from a letter like Marcus's. The failure point is this: every tax tool, human or software, can only work with the information you give it. A CPA who charges $300 to file your return is working from what you bring to the appointment. The software is processing what you type into the boxes. Neither one can know about the income you forgot to mention, the deduction you didn't know existed, or the form you didn't realize you were supposed to receive. The knowledge gap is yours. The responsibility is yours. And in a system that complex, that knowledge gap is where the money goes. This is why the 5 mistakes exist. Not because people are lazy, because the tax system is genuinely designed in a way that makes these specific errors almost inevitable unless someone points at them directly. So that's what we're doing. Marcus did freelance work, graphic design, a few $1,000s here and there across the year from clients who found him on social media or through referrals. Most of them paid him directly. Bank transfer, PayPal, sometimes Venmo. He reported the income from clients who sent him a 1099 form. That part he knew about. The clients who didn't send a 1099, the smaller ones, the informal ones, he didn't report. Not deliberately. He just assumed that if there was no form, there was no obligation. There isn't a threshold for whether income is taxable. If someone pays you money for work you did, that income is taxable. The 1099 is a reporting mechanism that kicks in at $600 per client for 2023 onwards. It doesn't define whether the income exists. It just means that above that amount, the payer is also notifying the IRS. Below it, the money is still yours, still earned, and still owed on. This is the mistake that showed up in Marcus's letter. 3 separate small clients totaling just over $2,000 in unreported income. The IRS cross-referenced what was filed against payment processor records and matched the gap. The fix is straightforward. Track every dollar of income as it arrives. Every payment, regardless of whether a form follows. A simple spreadsheet with the date, the client, and the amount is enough. If you want a slightly more structured approach, there's a full system for this in the spending tracking video. Same habit applied to income instead of expenses. Mistake 1 closed. Now here's the one that hits even harder. When Marcus filed, he listed his freelance income. He reported it as regular income and paid his marginal tax rate on it. Done, he figured. What he didn't account for, what almost nobody accounts for the first time they have self-employment income, is that freelance work, side hustles, and any income where someone isn't withholding taxes for you comes with an additional tax on top of income tax. It's called self-employment tax. It currently sits at 15.3%. It covers Social Security and Medicare contributions, the same contributions that get pulled from a W-2 employee's paycheck automatically. But when you're the employer and the employee, you pay both sides yourself. So here's what that means in practice. Say you earned $5,000 in freelance income last year. You might assume your tax exposure on that is roughly 10 to 12%, depending on your bracket. Add self-employment tax on top, and you're looking at closer to 25% of that $5,000 gone, before any deductions. The number changes depending on your total income and bracket, but the shape of the surprise is the same every time. People expect a smaller bill and receive a larger one, and they don't know why. Here's the partial solution nobody tells you about in the same breath. The IRS allows you to deduct half of the self-employment tax you pay when calculating your adjusted gross income. It doesn't eliminate the burden, but it reduces the taxable amount meaningfully. Most tax software catches this automatically. The thing to know is that it exists, and to verify it applied. And if you're earning consistently from a side hustle or any self-employed work, quarterly estimated taxes exist exactly for this reason. They let you pay in installments across the year rather than facing the full amount in April. Miss the quarterly deadlines and you add underpayment penalties on top. That's a separate layer of cost that is entirely avoidable. Mistake 2. There are 3 more, and the next one costs people money they don't even know they qualified to keep. This one is less about what people do wrong and more about what they don't do at all. There are tax credits available to low to moderate income earners that go unclaimed every single year at enormous scale. The IRS estimates billions of dollars in earned income tax credit go unclaimed annually because eligible people either don't know the credit exists, assume they don't qualify, or don't file at all because they think they don't have to. A credit is different from a deduction. A deduction reduces the income you're taxed on. A credit reduces the actual tax bill itself, dollar for dollar. In some cases, with refundable credits, it produces a refund even if you owed nothing. The Earned Income Tax Credit is the most significant one. It's designed for workers in lower income brackets, particularly with dependents, but single filers with no children can qualify too. The income thresholds change annually. In 2024, a single filer with no children could qualify with income up to around $18,600. Above that, it phases out. Below it, the credit is on the table. The Child Tax Credit, the American Opportunity Credit for education expenses, the Savers Credit for retirement contributions on lower incomes. These are all real money that the tax code is offering to people who qualify, and the only barrier is knowing they exist and entering the information correctly. Most major tax software prompts for these during the filing process. But the software only presents the question. It can't answer it for you. If you're unsure whether you qualify for a credit, it's worth looking up the IRS's own eligibility tools on their website. They're more readable than the main code, and they're free. The money is real, and it's unclaimed. This one requires going back to Marcus because it's the mistake that bothers him most in retrospect. He paid for a tax professional. He didn't just file incorrectly on his own, he paid someone $180 to file incorrectly for him. And what he got in return was a professionally assembled return that still missed the unreported income, still missed the self-employment tax calculation on one income stream, and didn't surface a credit he qualified for. How is that possible? Because the preparer built the return from the documents Marcus brought in. No 1099 for the small clients meant no prompt to check for unreported income. Marcus didn't mention the Savers Credit situation because he didn't know it existed. The preparer asked the questions the software prompted. Marcus answered based on what he knew. The preparer wasn't negligent in any dramatic sense. They filed what was in front of them. But Marcus paid for expertise and received data entry. And that distinction between someone who files your return and someone who actively audits your financial situation for tax efficiency is the gap where the mistakes live. There are two responses to this, and they depend on your situation. If your income is simple, a single W-2, maybe some basic investment income, there is almost no reason to pay a professional. The IRS Free File program offers free federal filing to eligible earners, and most state tax authorities have equivalent programs. The software prompts are sufficient for a straightforward return, and the knowledge you build by doing it yourself is genuinely valuable for future years. If your situation is complex, multiple income streams, self-employment, freelance income, business expenses, significant investments, a CPA or enrolled agent is worth the cost, but only if you arrive prepared. Bring documentation for every income source. Have a list of potential deductions. Ask specifically about credits you might qualify for. Make the professional earn the fee. Mistake 4 is paying for a service you didn't need or not using a service you're paying for correctly. Both are expensive in different ways. One mistake left, and it's the one that quietly costs people the most over time. You have until mid-April to file your return. Most people know that. What fewer people know is that some of the most powerful tax moves for the previous year can still be made after December 31st. IRA contributions, including the Roth IRA, can be made for the prior tax year up until the filing deadline. If it's January and you didn't max out or even contribute to your Roth last year, you can still do it right now and have it count for that return. The window doesn't close at midnight on December 31st. It closes in April. This matters because the Roth IRA specifically won't reduce your current year's tax bill. Contributions are post-tax. But a traditional IRA contribution absolutely will. If you're eligible to deduct traditional IRA contributions, that deduction reduces your adjusted gross income and therefore your tax liability. And you can still make that contribution work for the previous tax year even if you're sitting in the new one. The health savings account works similarly for people with high deductible health plans. Prior year HSA contributions can be made up until the filing deadline. Most people make their tax year decisions in real time as they happen. The January to April window for prior year contributions is essentially a second chance, a way to go back and optimize a year that already closed. Almost nobody uses it, which is the exact reason it's the last mistake on this list. Which of these 5 caught you off guard? Drop it in the comments. Particularly interested in how many people didn't know about the January to April IRA window. I suspect more than a few. He paid the $3,400. He set up a folder on his computer specifically for tax documents and started logging freelance income in a spreadsheet every time a payment came through. He opened an IRS free file account for the following year and did the return himself in about 2 hours. He found the saver's credit and claimed it. His return that year came back as a small refund, not a dramatic reversal, not a financial transformation overnight, just a corrected system, running correctly, producing the outcome the system was actually designed to produce when you know how to navigate it. That's the honest version of what fixing this looks like. Not thrilling, but the alternative is another letter in the mailbox, and now you know exactly what causes those. Before you close this video, 5 things worth doing or checking right now. 1. Make a list of every income source from last year. Every client, every side hustle payment, every platform, even the informal ones. Assume it's all taxable until confirmed otherwise. 2. If you had any freelance or self-employment income, verify that self-employment tax was calculated in your return. Most software handles it, but confirm it's there. 3. Look up the IRS eligibility checker for the Earned Income Tax Credit and the Saver's Credit. Takes 10 minutes. The amounts involved are real money. 4. If you used a professional, bring documentation for everything next time. Make the appointment productive. If your situation is simple, Consider whether free filing software covers your needs this year. 5. If you didn't maximize your IRA last year and you're inside the filing deadline window, check whether you still can. The prior year window is open longer than most people think. Tax season comes back around every single year. The people who get better at navigating it are the ones with more complicated financial lives. They're the ones who paid attention once, built the habit, and stopped treating April as a surprise. The letter Marcus got was expensive. It was also fixable, and the education that came with it ended up worth more than the $3,000 he sent back. Go check your returns, fix what needs fixing, and if you haven't started tracking income and spending as a year-round habit yet, the spending tracking video is where that foundation gets built. Same discipline, same logic, a completely different outcome by next April. You know the 5 mistakes. Now, don't make them. Stack smart.